Hi everyone. Okay, great. You should be able to see my desktop now. Let's get started. I'd just like to point out our disclosures before we get going. That the information and opinions in this report, they're for general information use only, and they are not intended as an offer or solicitation with respect to the purchase or sale of any currency or CFD contract. All opinions and information contained in this webinar, they're subject to change without notice, and it's been prepared without regard to the specific investment objectives, financial situation, and needs of any particular recipient. Any reference to historical price movements or levels is informational based only, and only based on our analysis as well, and we do not represent or warrant that any such movements or levels are likely to reoccur in the future. Futures, options on futures, foreign exchange and other leverage products, they involve significant risks of loss and they're not suitable for all investors. Increasing your leverage also increases your risk. Spot gold and silver contracts, they're not subject to regulation under the US Commodity Exchange Act. And contracts for difference, they're not available for US residents, not because we don't want to offer them, but because of regulatory reasons. Okay, we've got that out of the way. Now let's get started. Just bear with me while I pull up my information, and we'll get going now. Thanks everyone for joining. Hi Gabriel, thank you for joining today. Great to have you all here. Now let's just let me just tidy up this chart just one little bit, and just before we get going, because this is pretty much a oh, there you go, pulling up the wrong stuff, because this is a live webinar, and the markets are going on around us. We've just had some Eurozone data, and it has been stronger than expected. We got a much better than expected industrial production data, or the industrial production report, which came in for March at 1%. Which is much more than 0.5% expected, which really helped the annual level recover, even though it still is in negative territory. The other thing was the ZEW survey from Germany. That also picked up. It didn't quite meet expectations, so it didn't pick up as much as expected. So Germany, they're weighing a little bit on the euro. Now let's just see what the euro's done. Let's take a look at the short-term chart for this. As you can see, it's actually just slipped back again. Wasn't quite what I was expecting. I kind of thought that it might pick up, but what you can see on a very short-term basis, this is the RSI as well. What we're seeing here is that the around about this kind of 130.30 level in the very short term is starting to look a little bit overbought. So we're not getting too much traction on the upside. In fact, if anything, those of you who have been trading today will note that kind of movement is fairly lackluster. We're trading in quite narrow ranges, and as you can see there, the top of that range being 130.40, with the bottom actually being very well supported at 129.40. Now I'm going to show you another chart, because with euro at the moment, it's in quite an important position. It's in quite an interesting space at the moment. Let's just drag this over. So as you can see, even kind of yesterday and Friday, when we saw that dollar rally really gain pace on the back of expectation that the Fed would cut interest rates, would scale back their QE program. So we saw a real sharp decline in the euro. We still managed to hold very good support there. So those of you who may not have seen this cloud before, it's an Ichimoku cloud. It's one of many technical indicators you can use, but basically above the cloud is considered an uptrend, below the cloud is considered a downtrend. And those of you who may be new to FX, but you might have done a little bit of reading about it. The upside, that's called a resistance level. The downside is a support level, and usually because of FX, the way that FX moves, support and resistance, they're well respected in the market, especially on these Ichimoku clouds. So this support level here, which comes in at 129.30, is respected by the market right now. So that is the low. So currently we're trading at around about 130, as you can see. You can actually see it in this corner here, the live rate. So we're hovering above this, or we're hovering around about this 130 level, which is very, very significant. But yet, kind of in a more, it's certainly in the last 24 hours, what we do know is 129.30 is key support there. So if we were to fall below there, that would be significant bearish development. The fact that we're holding above there suggests that, maybe, what we're in for at the moment is just a bit of repositioning. So, obviously those of you who joined last week, or those of you who were trading the market last week, it was really all about the dollar. Euro dollar was being moved by what was going on in the dollar. Dollar yen was obviously the massive move. It got above that key 100 level. So let's take a look at what the dollar's doing. Now this is the dollar index. is the broad-based measure of the dollar, so the dollar against its largest trading partners. And as you can see here, it's backed off a little bit. This is a candlestick chart. Remember as well, the darker candlestick indicates a net down candlestick. So what we've seen is the dollar index really back away from this key resistance level here at about 83.5. It was the resistance level as well from 2013 and from March 2013. Sorry, so it's the highest level that we've got to this year, and it's a significant level because if we look back, we've been below this 83.5 level since kind of August last year. So it's a significant resistance level. It's no surprise to me that we've backed away from it, and that what we seem to be doing is just pausing for breath around this level. Just bear with me one moment. Sorry, I've got a little bit of a cold today, so you will have to bear with me. I do apologise for that. So what we're seeing is so the dollar index, so the dollar generally it's maybe not stalled, but it certainly looks like it might have paused for breath. So I wouldn't say stall, pause for breath. What does that mean for the crosses? Well, that means a few things. So one of the reasons why I'd say that it hasn't stalled is because let's take a quick look at the pound. I will go back into more detail about this, but I'm just looking at it from a dollar perspective. And as you can see, yes, euro may have recovered today, but the pound hasn't really. And if we were going to see a key movement if we were going to see a key kind of movement in the dollar to the downside, I think we'd need to see the pound really join in, and it hasn't done. So let's quickly go back to the dollar now. That some of the things that I've been looking at, what we may be experiencing right now. Yesterday we saw quite a sharp decline. As you can see, this is a daily candlestick chart. Sharp decline in euro on Friday, on Monday. Since today we've been kind of catching our breath a little bit. But what this can sometimes be called is a bit of a short squeeze. So yesterday's the last few days, sharp declines in the euro could have been, the market does tend to overshoot, so it could have overshot it. Maybe the market was expecting too much from the Federal Reserve. Maybe it was expecting too much dovishness from the ECB. We know that they've got those two things wrong in the past. So what we might be seeing is just a bit what we call a short squeeze. Now what happens to that is that you get a big push lower, and then the market kind of gets a bit of cold feet, so we push higher again, or people start taking profit, which has a bit of an uptrend, causes a bit of a reversal. But it's usually only a very short-term reversal, and it's just to do with positioning. So I don't think at the moment that this is going to be the start of a real big shoot higher in the euro dollar. I think if anything, 130.50 to 70 is going to be a resistance zone. So what happens during a short squeeze sometimes is you get this kind of upward, you get this bit of profit taking, upward, a counter trend type of movement, only for the short term though, and then people come in. Sellers come back in at a better level. So, for example, it's better to sell the euro at 130.50 to 70 than it is to sell the euro at 129.50 or 129.40 when you know that's a massive support level anyway. So interesting to know, there was a bit of the reaction that I was expecting from that industrial production number seems to have kicked in a bit later than expected. So we're getting back to that 130.20 levels, 130.25 key resistance levels, those 130.50. So they're the levels I want you to watch. Now Pan has asked me to look at dollar CAD, and I will gladly look at dollar CAD because dollar CAD obviously very important dollar cross. The CAD as well by itself is just important from a dollar perspective, or from a US perspective, because obviously what's good for the dollar is what's good, well, when the US economy is strengthening, it's good for the US dollar, yes, but it's also good for the Canadian dollar. So what we've seen here is the dollar CAD really fall quite sharply, back to parity nearly, on the back of some better than expected economic data. Then we got some weak Canadian data at the end of last week, which pushed us back up to this 101 level. But we are struggling to get above here. Now let me just zoom in to just make this a bit easier, because in fact, I'm going to change charts, so just bear with me, because I think sometimes these black charts can be a little bit intimidating. Maybe you're not intimidated by a chart. I hope none of you are, but if you are, I'll get back to this chart. But it's also just a bit easier to see. So this is dollar CAD, this is it on an hourly basis, this is it on a daily basis. So that was very similar to the chart you just saw. So really, this is the this red line here is the 200-day moving average for, let me just double check that is the 200-day moving average, I'm pretty certain. Yeah, 200-day moving average for dollar CAD. As you can see, that's held as fairly good support. We're kind of oscillating really around about that 101 level, and just trading sideways really. But if I just draw something on here, one moment, what we're really seeing is a bit of a symmetrical triangle. And what that means is that kind of what symmetrical means, it could go one way or the other. I'm not getting too much, I'm not really I'm not in conviction right now for dollar CAD, and you can kind of see that, like, you know, momentum indicators aren't really showing us going anywhere. They're kind of in the middle of their ranges. When I'll get excited about dollar CAD is when it gets to either this level, which is just below 102.50, or if it gets below here, so around about 100.30. A break below there is a very bearish development. Obviously, a break out of this triangle is a bullish development. So, Pan, I'm not too excited about dollar CAD. Let's just take a look. Maybe I'm wrong I don't feel like I'm wrong on the shorter term charts either. This is the hourly chart now. I kind of feel like I don't get a good sense on where it's going. The price action to me is suggesting that it's going one way or the other, and it is confusing. So I hope I just kind of helped confirm that for you. But as I said, some key levels to watch though, Pam. So do make note of them. As I said, 100, just below 100.50 on the downside, 10 just below 102.50 on the upside. When it gets to those levels, then I'm going to get more excited. And there is some, you know, more interesting fundamentals coming up. Obviously tomorrow's US CPI data at 1:30 UK time. That's going to be important. Gabriel, you've just asked me about dollar Swiss. Again, another important dollar cross. Oh, bear with me. I'll just pull up that chart. As you can see here, again, trading sideways. Oh, I should let me get just change this band here. Again, you know, trading in a range, seems to have broken out of that range, but really not with too much conviction. So this 95 level, we've seen it. It's a massive level. We pointed it out before. Really, really important. But we are seeing a little bit of hesitation above there. As long as we stay above this level, which comes in around about 94.75, to me that's a really important support level now, because I think that a daily close below 94.75 could negate this kind of push up that we're seeing. Now again, as I said, like, you know, the dollar rally that we've seen has been impressive, right? It got us back above the 200-day moving average and pushed us back above 95. Because I said that, you know, the markets can sometimes overshoot on the upside, or on the upside in this case, then a pause for breath around about this 95 level is perfectly normal. Gabriel, you're saying you're bullish on dollar Swiss. I see your reasons for that. Certainly from a relative central bank perspective, maybe that's something that you're looking at. Maybe that's why you're bullish. Potentially that's the reason why. I think the fundamental picture is very supportive of a stronger dollar Swissy, but obviously you've got to go with price action when you trade the FX market, and the price action at the moment is saying, hey, we're pausing for breath. Now if there's a pullback towards 94.75, I think that could attract some buying interest, and that could be what gets us higher. But again, I think we're going to need a fundamental driver for that, and I'm not seeing that until tomorrow when we get the CPI data. That to me is the key thing that we're looking out for. And I'm kind of with you there, Gabriel, with the Swissy. I think from a fundamental perspective it looks very weak, and it has done obviously for a while because of what's been going on with Euro Swissy and the banks. But I agree with your hesitation there. I would be a little bit hesitant until maybe we see a decline back towards 94.75. I think if we were to get a weaker than expected inflation report from the US tomorrow, that could see further declines in dollar Swissy. But I do think that people will pick it up from about kind of 94.50 to 75, I would say, in the short term. Okay, I also just want to show you as well, just let me bring up the other chart of dollar Swissy, just get a different perspective on it. Take a quick look. No, I won't actually. That seems about right. But as you can see as well, just also to draw your attention to, obviously between kind of 70, this is the RSI chart, this kind of second thing here, between kind of 70 to 80 and 30 on the downside, they're really important levels for this RSI. So right now we're trading at around about 66, and that seems to be where the sellers came in. So people are taking profit at these levels, which again is another indication that maybe the market overshot itself in the last few days. So what we're experiencing now is a little bit of a pullback. Now, Pound's asked, is sterling Swissy correlated? Well, yes, it is. And the reason why, let's bring that up. It is correlated because obviously sterling Swissy is not the most liquid cross. So what it is, it's kind of an amalgamation of what's going on with sterling dollar and Swissy dollar. So what we're seeing here again is just a little bit of kind of trading sideways, because right now the dollar is weak against the Swissy, or is pulling back against the Swissy, and the pound is weak. So it's kind of neutralizing that dollar impact. So what we're seeing is again, it's just a little bit of movement. This 200-day exponential moving average. It's oscillating around this level, just below 145, 144, just below 146, my apologies, about 145.85 is kind of a key level, but again above there towards 147 started to look overbought actually, so a pullback is very much expected, but we are holding support here. Seems to be kind of 145.85, maybe 145.5 as well, is worth noting. I think I'm going to go back to the pound right now. As you can see, another weak day, another down day. That's what's one of the other reasons I said at the beginning why I'm not so convinced that this pound move is necessarily I don't necessarily think this pound move is dollar move is a sort of a weaker dollar in the medium term. I think it's just pausing for breath, because we've seen the pound continue to weaken against the dollar. Now it's a big week for the UK. Tomorrow we have the inflation report, last inflation report from Irving King, but it could also be important if it weakens the inflation outlook for the next year, or if it drops its inflation forecast for the next 2 years. So if it revises that lower, that could be pound negative. And I think that's what's getting priced into the market now, an expectation that the inflation report tomorrow, which for those of you who don't know, is just an important fundamental released from the Bank of England. It's a lot of pomp and ceremony in it, with everything, isn't it? In the pound, which we could see, whereby we could see, we get the latest bank projection. So there's a lot of, from a fundamental perspective, things are looking quite weak. Now, there was an important fib level here, which fib level of resistance here as well, and quite a few that I've been mentioning for a while now. As you can see here, we got through, we had a nice recovery. So we had, after this, on a medium term basis, let's just talk through it. We saw that decline for most of this year up until March, whereby we started to recover. The recovery was certainly more incremental than the decline. As you can see, the decline is quite short, sharp, steep. The recovery was a bit more like steps, step up, step up, step up. So it was a little bit hesitant, and indeed it ran into resistance just below 156, which was the 50% retracement of that down move for the first 3 months of this year. Yet then on Friday we cut through, almost like butter cuts through a knife, the 38.2% retracement, which is the 154 level. Since then we've been declining ever since. Now right now, again, we are pausing for breath a little bit on the downside, but I do tend to think my reaction is that if we do fall below, if we do get a close below 153, it really does open the way for a sharper decline towards this kind of 152.25 level in the very short term, and then towards this kind of, these lows here around about kind of, just below 151. I don't feel like the momentum's there. I'm not seeing it in the price action. I'm seeing some nice reversal patterns at the top here. I think 156 is a medium-term high. Gabriel, you've mentioned something. For me, broke out of price channel. What was your opinion? I mean, yes, I'm assuming what you mean by that is this kind of night. Oh, sorry, let me just change this to an extended. It's not quite right. I'll take that one off. But I'm assuming what you mean is this. And again, that break below one, it's around about that 154 level. Very important. It's the 38.2 or the 38.2% retracement of that recovery of the down move. Should have acted as key support. It didn't. We got through there, and I agree. I feel like we're now maybe in a bit of a new paradigm. It does obviously give us some important levels. I think, we could see some. If we do see it, we're seeing a little bit of recovery today. But if we get back to kind of that 153.85 level, I just think that the sellers will come in, and people could potentially sell it on the back of a dovish inflation report, for example, tomorrow. I think right now, for me, the bias is lower in the pound from a technical perspective and also a fundamental perspective. So that's kind of what I'm saying. Again, this is the daily chart. We're not looking oversold either, so there could be more room on the downside. From a short-term perspective, as you can see, we are starting to just pick up, just find a good support there around about kind of just below 153, so around about 152.80. So let's move on. We're going through things really quickly, but that's good because I think there's a lot going on. This is the Aussie chart, so Pam's looking at Aussie. Can it go lower? Let's take a look at a longer-term chart for that answer. As you can see, this is the Aussie. Talk about being thrown like a stone. It's just fallen like a lift. So now it's important to look kind of slightly longer term chart to see if it can go any lower. So we have breached an important level. We've had a very large move lower in the past week. Broke below some key support levels that are really important over the last kind of year, really. But yeah, I mean, there was a weaker level around about June last year. So do you remember that was before Draghi said, "I'll do everything it takes to save the euro," which comes in at just below 97. So yes, it could go lower. There's a key support level around about 98.70, which is the 200-week moving average. That's now going to be on people's radars, I think. Investors. Or the FX community, it likes to look for levels whereby things might take a break, whereby it could be an exciting opportunity to re-enter a trade or something else. Obviously, a break below this kind of 90, this 200-day moving average at 98. What did I say? Around about kind of 98.70. A break below there is a very bearish development for this cross, but because it's such an important support level, we would expect a bit of stickiness around there for the market to respect that level. Let's go back just to the shorter term. Look, as you can see, we've got to that kind of 99.25 low earlier today, and we've since kind of recovered a little bit. I would say, we did get as high as kind of above parity to 101.20. That seems to be the very short-term range that we're trading in. Again, I think it will depend where this pair will go. We had an Aussie budget earlier today. It didn't really tell us anything that we didn't know already. One thing I would point out though is that below kind of around about 99.25, below 99.50 really, we are starting to look very, very oversold in Aussie. This is perfectly to be expected. I would expect a bit of adjustment, maybe to back above parity, maybe towards 100.50, maybe even towards 100.90. But for me, that would then be used as a selling interest. Now, someone said, Pan just mentioned as well, is all the negativity priced in? Well, to answer that question, you've got to know what is the negativity. Well, the negativity is that growth in Australia will slow down. It's the peak of the mining cycle, which is expected to peak early next year. Well, no, I don't think it will all be priced in, especially if the mining cycle actually peaks sooner than the government thinks. That will spell very bad news for the Australians, for the government and for Australian growth outlook, which I think could cause further weakness. Now, I do think it'll be incremental. I do think it'll be incremental on this, and I do see this as more just as a positioning, but I would say as well, we are looking very overbought right now, so time for a bit of recovery. The other thing that I would point out, not on this, let's move on, one moment. Oh, sorry. Okay, euro sterling. Nice recovery there, as I said. You know, the pound had fallen very, very sharply the last few days, which had a big impact on some of the pound crosses, particularly euro sterling, which has made a nice recovery. This is just the 30-minute chart, as you can see. You know, very, very short term. Starting to look a little bit overbought on the short term, so we could see a bit of resistance ahead of this 85 level, but that is a massive resistance level as well. Let's just widen this time frame a bit. Yeah, as you can see there, again, still looking a bit overbought. So 85 could be quite sticky in euro sterling. Could attract a little bit of people taking profit. But I think if we were to pull back towards kind of that 84, 50 to 70 level, that would potentially could attract more buying interest, especially ahead of that inflation report tomorrow. Ahmed has asked, good question. Does gold have any effect on Aussie? Yes, you could argue it does. The gold decline, though, I don't think by itself explains the Aussie decline. Interestingly enough, Aussie used to move quite closely with S&P 500. That relationship has totally broken down in 2013, with the S&P obviously making fresh record highs and the Aussie falling, you know, to multi-month lows. So let's take a look at the gold price here. And I'll bring up a chart of the two so you can see it. Let's, oh, no, sorry, it's not that. So as you can see, this is gold finding its feet really around about 14.25, not really doing too much. Recovery does seem to have stalled around about 14.80, so ahead of that 1500 level. Now we think it could potentially pop back up above 1500, but we actually think that would be, potentially a short-term move, and that gold for us, the outlook for gold, while the Fed is still contemplating the end of QE3, I don't think that the gold outlook looks too good, but I do think, remember, it's an important gold buying Indian festival at the moment as well, so that is protecting the downside. So what we are seeing in gold is that there's a lot of physical buyers having an impact there. Jack just asked me a question: if inflation rises, can bond yields go higher like Japan, and JGB, or what impact to yen? Jack, I'll answer that in one moment. But gold is interesting. I think it's a sell on strength rather than a buy on dips. That's my personal opinion. But does it really have a big impact with the Aussie? As you can see, not really. The Aussie has had a much more violent move, suggests that that's kind of Aussie specific. It's not necessarily moving in line with gold, at least not in the short term anyway. Let's take a look at bond yields. I did put out a piece yesterday. And I'll just give you the link. Hang on. This is our latest research. It's our latest research page on forex.com, where you can go and see all our research, and please do go and see it. But so higher inflation, JGB yields rise. So what Jack's asking me, I think, is about higher inflation in Japan. Inflation in Japan, hopefully, that's what the government wants. What does that mean for the yen? Well, I think in the short term, if we do get higher inflation, I think that's still yen negative, because I think it supports what the Bank of Japan is doing. Now, I'm just going to bring up this chart. This will be the last thing that we look at, guys. I know that I'm holding you up a little bit here, but just bear with me one moment. Obviously, for dollar yen as well, a really important relationship is this one, which I'm just going to show you. So this is dollar yen, which is the white line on this chart, and then the red line is the spread between US 10-year yields and Japanese 10-year yields. So Jack brought up a really good point, that JGB yields have risen, yet the yen has fallen. Well, Jack, that is largely to do with interference from the Bank of Japan. So when the Bank of Japan becomes a massive buyer, a lot of people sell their holdings, but there is, and that can sometimes cause bond yields to rise in Japan. So what we've seen here is the spread between US and Japanese yields really diverging. So the spread has moved lower, yet dollar yen has moved higher. I do think if we would continue to see a decline in this spread, so for example, if US bond yields were to continue, for example, to fall, then that would be negative for dollar yen, but I don't see that really happening. If anything, I think, dollar yen, I think after a pullback, maybe towards that 170 level, is probably going to initiate more buying, and that we'll meander higher up towards 105 over the next 3 months. Ahmed's asked a good question. Heard Japanese investors are buying overseas assets. What is this, please? Yes, so basically there's been an increase in the number of Japanese people buying overseas assets. So Japanese big investors, big domestic investors, when they buy overseas assets, that means that they're selling yen, buying foreign assets, which can be yen negative. We've seen some very incremental or very short-term views that that's the case. Some data suggests potentially that might be the case, but what we are really thinking about is, or what we really need to see is just to pick up in that asset buying. So it seems like maybe the market's turning a corner, but we're not there yet. So that's a good point. That data comes out weekly every Wednesday. Do watch out for it. We'll be following it. It's worth seeing that. Anel's just asked me, where do I see gold going in the long term? I think it depends on the time frame. I think the next 6 months, I think it's going lower, and I think we could see 1200 in the next 12 months. Okay, everybody, that is going to be about it from me. Thank you so much for joining. Great questions, as always, really engaged. It makes for a fun session for me, I have to say. So thank you so much for joining. Please do join us next week for more, and good luck trading this week. So thank you.